You look around the world right now, there's wars, political instability, all kinds of tensions simmering. And when investors get nervous, one ancient asset always comes back into the spotlight: gold. Right now, its price is absolutely soaring. So, in this explainer, we're going to figure out if you should be buying in at these all time highs. And I'm not kidding when I say soaring. Gold has recently blown past its old records, smashing through some major psychological barriers. The whole financial world is buzzing about it. It's actually the second massive gold rally we've seen in just the last couple of decades. So that brings us to the million-dollar question, right? When something hits a record high, is that your cue to jump on board, or is it a huge red flag warning you of a bubble? Well, to figure that out, we really need to dig into the why. Why would you want to buy gold in the first place? Okay, here's how we're going to tackle this. We are going to break down the biggest arguments for buying gold one by one. We'll look at what's driving this current rush, and then we'll put the most common claims to the test. Gold as insurance, as an inflation hedge, as a way to get rich, and as a diversification tool. By the end, you'll have a really clear framework to decide for yourself. First things first, let's get right to the root of the issue. Before you decide whether you want to join the crowd, you've got to understand what's making them run in that direction. What specific fears are pushing the price of gold to these historic levels? So, what we're seeing right now is this potent mix of geopolitical anxiety. You've got the war in Ukraine, you've got fears about political instability in the US, and of course, the growing tensions around China and Taiwan. But here's the kicker. The single biggest buyers on the market right now, they're not everyday folks like you and me. They're governments. They're central banks. Let's take a closer look at what they're up to. Wow, just look at this chart. The shift is dramatic. Before 2022, you see central banks were buying gold, sure, but it was steady. Then, after Russia invaded Ukraine, their buying just exploded. Now, this wasn't just a simple reaction to war. It was a reaction to the consequences of that war, which brings us to the first major argument for owning gold. All right, let's examine claim number one, the idea of gold as the ultimate form of insurance. The thinking here is that gold can protect your wealth from the most extreme kind of political and financial risks, things like sanctions, or even having your assets completely confiscated. So here's what happened. In response to the invasion, Western governments froze hundreds of billions of dollars of Russia's foreign currency reserves. That sent a shockwave, a really chilling message to every other country on the planet. And the message was, if you hold your money in dollars or euros in foreign banks, they can be taken away from you with the stroke of a pen. But if you buy physical gold bars and you stick them in a vault inside your own country, no foreign government can touch them. They can't freeze them. It's pretty much the only financial asset you can have that gives you that kind of ultimate control. And that is why central banks are buying it up in record amounts. It's basically sanction-proof insurance. Okay, so that logic is absolutely rock solid if you're a country like China or Russia. But what about you? What about me? Is your personal savings account really at risk of being sanctioned by a foreign government? I mean, for most of us, that's a pretty far-fetched scenario. So while this totally explains why the big players are buying, it might not be a very compelling reason for an individual investor. All right, now let's tackle the most common belief about gold, the one you hear all the time, the idea that it's this amazing shield against inflation, protecting your hard-earned money from losing its value over time. I'm sure you've heard some version of this famous saying, right? It's a brilliant little story that captures gold's reputation as this incredibly stable store of value over thousands of years. The argument is simple. Currencies, they come and they go, but gold's purchasing power, it just stays constant. But, and this is a huge but, this is where things get really tricky, because your time horizon matters a lot. Let's look at the 20 years between 1980 and 2000. During that time, the US dollar lost over half its value to inflation. So, based on that store of value logic, gold should have been a superstar, right? Instead, its real inflation-adjusted value plummeted by 80%. It was a terrible hedge. So what gives? Well, it's because gold's price isn't really tied to inflation. It's tied to fear about the future, which makes it a really unreliable shield against just simple price increases. So what's the verdict on this one? Look, in a true catastrophic hyperinflationary collapse where your currency becomes totally worthless, yeah, you'd be incredibly glad you owned gold. But for protecting your money against the normal single-digit inflation that most of us experience in our lifetimes, the history books show that gold is surprisingly unreliable. Okay, so a lot of people aren't just thinking about protection, they're thinking about profit. They see that price chart going straight up and they want a piece of the action. So let's evaluate gold purely as a way to make money. To really understand gold's potential, you have to grasp what it fundamentally is. Gold is a non-productive asset. It's a chunk of metal. It just sits there. It doesn't make anything. It doesn't generate any income. The only way you can make a profit is if you find someone who's willing to pay more for it than you did. Stocks, on the other hand, are totally different. They represent actual ownership in real businesses that generate profits, grow, and can even pay you an income through dividends. And this brings us right back to that cow example. The very reason gold is a good store of value, the fact that its purchasing power is stable over centuries, is the exact same reason it's a poor long-term investment for growth. It doesn't grow, it just is. Over the long haul, productive assets that actually create new economic value have always delivered far better returns. Okay, so we've poked some holes in a few of the popular myths. But now, let's look at a reason that the pros, the professional investors, actually find pretty sensible. And that's the case for gold as a portfolio diversification tool. The magic word here is correlation. And don't worry, it's not as complicated as it sounds. Think of it like this. Your stock portfolio and gold are like two kids on a playground. They aren't holding hands and running in the same direction. In fact, a lot of the time, they do their own thing. This low correlation means that when your stocks take a nosedive, gold might be going up, or it might just be sitting still, which helps cushion the blow to your overall portfolio's value. And because of this low correlation, adding a small amount of gold to a standard portfolio of stocks and bonds can actually lower your overall risk and smooth out your returns over time. Now, we're not talking about betting the farm here. Most experts suggest a pretty modest allocation, usually somewhere in the range of 5 to 15%. That's enough to get that diversification benefit without seriously dragging down your long-term growth. So, we have walked through all the key arguments, from geopolitical insurance all the way to portfolio math. Where does that leave us? Well, the reality is, there is no simple yes or no answer. The right decision for you depends entirely on what your goal is. It depends on your why. And your goal also determines how you should buy it. I mean, if your number one concern is insurance against some kind of true societal breakdown, then you need to own the physical stuff. You'd want to buy gold coins or small bars that you can actually hold in your hand. But if your goal is just simple portfolio diversification, owning physical gold is a huge hassle. In that case, a gold ETC, that's an exchange-traded commodity, is way more efficient. You can buy it easily through any brokerage account. So let's just summarize this all in one place. Think of this as your cheat sheet for gold. Is it the right tool for your job? Well, if you want insurance against catastrophe, yes, physical gold is a great fit. If you want to hedge against typical inflation or get rich quick, nope, the evidence shows it's a pretty poor choice. But for smart portfolio diversification, yes, a small amount through an ETC can be a very sensible move. Look, at the end of the day, buying any asset when it's at an all-time high has risks, and gold is no exception. There are absolutely no guarantees it's going to keep climbing. But now you understand the different roles it can play. You have the framework to look past all the hype. So the final question really isn't, should I buy gold? It's, why would I be buying it? You have the evidence. What's your reason?